everyone, and welcome to the latest edition of the Expert Series by Scottish Widows. Today's session is focusing on the impacts on you, our employer clients, following the changes to the national insurance that was announced in the last autumn budget. These come into effect from the new tax year, and so today we're going to highlight some magic to minimise what is effectively an increased cost to your business, which we know might give you some tricky decisions to make. Look, this magic is real. We call it salary exchange. My name is Stuart Hopley. I'm one of the directors here at Scottish Widows, and our team of relationship managers support all of you. I'm your host for today's session, and I'm joined by Susan Hope, our Business Development Director. Now, Susan is our salary exchange expert with a difference. Not only does she have an anorak, she knows everything about salary exchange, but she's turbocharged with enthusiasm, as you'll see in a moment. And what she wants to do is help everyone make the most of what salary exchange can do. Now, before we look at our agenda, I'd like to get you all involved and launch our first poll. And it asks a simple question. How do you utilise currently salary exchange across your business? We know it's not a new concept, so many of you will have looked at this already, and some of you absolutely will refer to it as salary sacrifice. So those two terms are interchangeable. Susan might explain a little bit later why we use salary exchange rather than salary sacrifice. So the options in our poll is yes, we do offer this, but only for pensions. Yes, we offer this for pensions and more, or no, you don't offer this. And I'll look at the results in a little while. So what's on our agenda for today? Well, we'll recap what salary exchange looks like today and how a lot of the budget headlines make this even more important. We'll cover how to implement salary exchange and set yourself up for the best success. And of course, getting your people engaged with salary exchange is half the battle of having success. So we'll cover the key benefits to promote why this is worth doing. We will also be sharing some new material as part of Susan's key tips and how we can support next best actions through governance. You'll be able to access that material from within the resources area of this webinar platform, and it includes our salary exchange webpage, employer guide, employer checklist, there's a video, a calculator, and of course our Retire Well webinar series. That calendar is in the resources area as well, and your people can learn more about pensions as part of that webinar series. And as always with our expert series, today's webinar is being recorded, and we will share the playback link with you via email so you can refer onto it or pass it on to anybody who missed the session. While we're live, you can ask us a question using the Q&A function on the left-hand side of your screen. That's just under where you're seeing me. Our fabulous colleagues, Chris and Damien, they'll be answering your questions in the background, and we will, of course, leave some time at the end to cover your questions. So let's have a look at salary exchange. And as I mentioned, it isn't a new concept. The earliest reference of salary exchange does date back to the 11th century, but salary exchange as we know it, it began around 50 years ago. It provides cost-free, flexible benefits to the employee through channels like cycle to work, car lease schemes, health and well-being benefits, and of course our favourite, pension contributions. Now, the rise in national insurance costs for employers, it is just around the corner, but it's always been prudent to start the salary exchange discussion, especially so since we are now 13 years into auto enrolment, and there are still a huge number of pension schemes out there that were either set up without salary exchange or just not utilising it in the best way. And if I have a look at those poll results now, in terms of utilisation, actually, we've got a decent split here in terms of our audience. There's a third of you that don't offer it at all. And of the 2/3 that do, the vast majority, well, actually, not a vast majority, ever so slightly, most of you offer it on all benefits, which is great. But there are a good amount of you that offer it only for pensions. So you might want to consider opening up those wider benefits too. In comparison to that poll, and as a temperature check, we took a sample across our workplace pension schemes, and just over 50% of them have told us they're using salary exchange. So certainly you, our audience today, are slightly higher than that figure. We absolutely know many UK businesses are under pressure. We've seen several changes to national insurance rates in a short period of time. It's understandably caused confusion for employers and, of course, employees. And we know that your costs are rising as an employer. You might be struggling with attracting or retaining staff as a result. You might, as I mentioned in my opening piece, be making some difficult decisions right now about where you spend money because of these increased costs. We know that implementing or making the most of salary exchange and using the national insurance saving, that can help get cash flow back into your business. So that's why we're highlighting this today. When it comes to salary exchange and pensions, there's a few things to consider. Do you offer this on salary or bonuses too? How do you apply the employee saving? You can choose to increase take-home pay, or you can choose to increase the pension contribution, so help people's retirement outcomes. And you as the employer can choose what you do with your employer national insurance saving. From our records, 53% of employers are using salary exchange. Over half of those keep the national insurance saving themselves. At least one employer that we regularly run webinars for articulates that that saving is used to pay for the death in service benefits that they provide their employees. 11% of those employers, they split the benefits between the business and the employee, and a third of employers that offer salary exchange do share the national insurance savings with their employees in full. So hopefully some interesting numbers for you there. And look, Susan's our expert. Let's see what she's got to say. Remind us of the budget headlines, please, Susan, and how our audience can set themselves up for success.
Brilliant. Thanks, Stuart, for that introduction to our session this morning. Delighted to be here this morning speaking about one of my absolute favourite subjects, and that is salary exchange. So we know, as Stuart has said, more than ever, that employers need ways to increase meaningful employee benefits. So not just a pizza on a Friday. What is going to be meaningful to your employees without putting more pressure on your costs? And salary exchange really does provide that opportunity. When it's implemented properly, it creates a real win-win for employers and for employees. I really do believe this, that it's one of the few genuinely effective levers that you can pull that can create new value for you and for your employees, rather than just redistributing, easy for me to say, existing value. Now, I know many of us have been working with salary exchange from years now. I certainly have, and it's as old as me, being back in the 70s it was introduced. We know that it works, but it does need a glow up. So what we want to do on this call is look at how we can improve on how we implement it, how we review it, and how we communicate it. So at Scottish Widows, we've helped implement salary exchange programmes for organisations ranging, as Stuart said, from FTSE 100 companies to growing SMEs with less than 50 employees. And what we do know, and hopefully this is meaningful for you, what we do know is that pension schemes operating salary exchange have on average an 11% increased participation rate. And in addition, businesses report a 14% lower staff turnover rate compared to their industry averages. And in the interest of saving the best stat till last, I do love a stat. According to a survey published by Mercer last year, for every £1 spent on implementing salary exchange, the employers saw an average return of £5.20. And that's in a combination of NI savings, but also really meaningfully in this environment, reduced staff turnover. And this return on investment is going to be increased as we move into the world of 15% employer NI post-April. So today we'll examine salary exchange from 3 perspectives. Stuart's already touched on the evolving landscape of salary exchange, and we're going to get into how to future-proof your approach for the 2/3 of you that already implement. For those employers, I think it was a third that was the result of the poll. For those employers not yet using salary exchange, we'll run through a reminder of the business case and a potential implementation roadmap. And for those employers with salary exchange in place, we'll look at how you can optimise your strategy and common pitfalls that we see all the time and common employer questions as well. But please do put your questions in the chat. If we can't get to all of them, we will follow up afterwards. So let's cut straight to a refresher on the numbers. And we know that the changes that we're looking at are significant. Now, you'll all be aware of these, but just as a quick recap, we know that the employer NI threshold for paying employee NI has been slashed from £9,100 to £5,000. So a hefty 45% unwelcome reduction. And then we've got the double whammy that the employer NI rate is jumping up to 15%. So, and I'm sure you'll be all over these numbers. On an average salary, I think the average salary in the UK is about £35,000 at the moment. That's an extra £926 per employee in your cost that you need to find every year now. There's some small respite here on the employment allowance, where we've got the removal of that £100,000 NI cap. So more employers will benefit from that one-off payment every year, an employment allowance, one-off allowance, which is now £10,500. So a little bit of muted benefit there. And then, listen, we're alive to the fact that you're also needing to find more cash, because we see the national living wage go up. So for a 21-year-old, they're going to experience an increase of £27 a week, just under. So you've got your 926 quid to find a year for your average wage. And then you've got £1,400 a year to find for people who are on national living wage. So like, we are well aware that this is a difficult time for our employer clients. I'm going to look at what that picture really looks like for an employer with 1,000 staff. This is a busy slide that I'm about to show if we move forward to the next one. So I'm going to just build on it just to give you an idea of what the costs are, but also a good news story and how we can use salary exchange to mitigate some of those costs. So without salary exchange, as I've said, you're looking at £926 per employee, but for 1,000 staff, obviously, that's £926,000 per year. Now, if eligible, you can reduce that cost down to £915,000 a year. Every little helps, right? By that £10,500 employment allowance. So increased cost of nearly £1 million a year. But then using salary exchange, we're not avoiding the whole cost, right? So we do have this additional cost, but you are able to generate additional savings of up to nearly £300,000 a year by utilising salary exchange. So as a recap, there are two ways to implement salary exchange for employer costs. Employers either keep all of the costs, they save all of the costs, or somewhere in the middle they can give some up. So I think Stuart mentioned earlier, we've got more than half of ours keeping the cost, and then we've got a third doing somewhere in between. So this does help you potentially have a 28% in a reduction of your costs. So I do believe that the benefits very much weigh any negatives that could be perceived. So that's it in a nutshell for 1,000 staff. Obviously, we can do these we can run these numbers for you if you would like them specific to your own payroll. Happy to help with that. But potentially 28% reduction in cost just purely by using salary exchange. Right. Here are the headline numbers, right? I love these numbers, and these are the numbers that I like to talk about all the time. Probably why people avoid me on the tube and in lifts, etc. But really important numbers. So for every £100,000 that you've got in exchanged contribution, you can save £15,000. So direct, measurable reduction in your payroll costs. Or if you are having issues with building your employee benefits because of a lack of cash, or you're having trouble with attracting and retaining staff, you can talk about the 28% increase in employee contribution for a basic rate taxpayer purely through implementing salary exchange. No need for anyone to find extra money. I find that really compelling, and I'm going to put a pounds and pence figure on that later on as we get into the proof points that we can provide for you. So let's move on to making this tangible through the practical implementation of a successful salary exchange project. Now, for those of you who have already got the scheme in place, this next 5 minutes is going to be mainly a reminder of things that you can do when reviewing your arrangement, just to make sure that you're definitely getting the most of it. Certainly with that move from 13.8% NI to 15%, probably a great time to review your salary exchange project or your arrangement. If I move on to the next slide, my day job is to go out and speak to advisors and employers, and I can genuinely say I've been doing this since, well, I started in 1992, but that's another story for another day, where the highlight of my job was my £1.50 luncheon vouchers. Things have definitely changed if I'm now really passionate about salary exchange. But I speak to advisors and employers every day, and we have never had such clear messaging around the focus employers have got around that tight cost management. Every ounce of measurable and meaningful value needs to be squeezed out of every penny spent. So we've got the age-old problem about lack of understanding and perceived complexity of communication and implementation, right? That's still prevalent, as is the employee cynicism about any changes to their compensation structure. But there is a positive here. So the CBI did some research. The CBI did some research a couple of years ago, and I was really encouraged that 93% of employers who implemented salary exchange said that it was easier than they expected, and 87% said they would recommend it to the other business. So when people bite the bullet and actually do it, I would say that that's a resounding yes vote, and it is worth it. With the employee cynicism point, I'm sure we've all got experience of cynical employees, noisy employees, railroading what could have been a successful salary exchange project. And the starting point to addressing that is basic, and it's in the terminology. And there's two aspects to this: the language we use and the explanation. So I think I said earlier, salary sacrifice needs a glow up. It's 50 years old and we're still calling it sacrifice. If we think about the word sacrifice in its most basic form, I mean, I don't want to hear about the images it conjures up, but it's not pleasant. It implies loss and can create hesitation, resistance, and loss aversion bias to occur. It just brings up totally unnecessary psychological barriers with people because they believe that they're giving something up. Salary exchange, on the other hand, implies, gain, mutual benefit, something positive. It's more positive for your employee communications. If we improve the language, we can definitely improve the take-up. Now, HMRC does recognise both terms equally, so let's get on with it. If I had my way, I would have an industry swear jar every time I heard salary sacrifice being mentioned. So I am definitely a fan of changing the language to reflect actually what salary exchange is, which is an exchange of gross salary for an employer contribution. Secondly, how we communicate this is so important. This is access to free money for your employees, end of, either in their pay or in their pension. Even if you keep the saving, they still have their saving. So this is because the exchanged amount just doesn't hit the employee's payslip. End of, that's it. So let's really try and focus on simplification of the message. And that's what we've been trying to do at Scottish Widows. We've got a whole suite of new collateral that is trying to keep it really benefit-led and simple to make sure we drive those messages home. For those of you, I get asked this all the time, for those of you on the call wondering about the future of salary exchange as well, the government's own analysis shows that salary exchange supports their broader pension policy objectives by potentially increasing overall retirement savings levels. And that's why, although it's been changed when it's been reviewed, I think the last full review was back in 2017, it has been preserved in various different tax reforms, although it has been narrowed. I'm alive to that. So we're as confident as we can be that it's here to stay, but who knows? The pace of politics is so fast now. So I'm going to quickly move on, just a quick whiz round what a good implementation would look like, and a call out here to some of our new collateral. So I'm going to cover this at high level. The top line here are our stages of implementation, and the bottom line is all of the collateral that you can rely on Scottish Widows to provide you to help you. I won't get into it in too much detail, but it is here, and you can get great support from us. We're here to help you every step of the way, end to end. So the difference between, we all know this, the difference between a standard salary exchange programme for compliance and an optimised one, where you're getting the most of the saving and your employees getting the most of their saving, is the difference between a compliance exercise and a real competitive advantage. So we begin with a detailed financial analysis. This will help you determine the potential savings for you and for your employees. Now, remember, there's going to be a nuance. The figures are really clear and simple if all parties are keeping the saving. But because we start off an equalisation point for take-home pay, the exchanged amounts will be greater if you're going to be reinvesting all the savings. So we've got a salary exchange estimator and an in-depth calculator, both for individuals and for schemes. So it's worth reviewing. For those of you who are on the call who already have exercises, it's worth reviewing what are your new numbers going to look like post-April. We then want to look at, you'll want to look at outlining the specific benefits for your individuals. Like, they really need proof points. I don't know about you, but I want to know where every single penny of my hard-earned cash is going, and I want to know what impact it's going to have on my retirement. So the individual calculators will help give a before and after picture for your employees. And they can be used every single year just to reconfirm that value of the salary exchange exercise. Really important to make sure that your employees are clear. We know that employee understanding directly correlates with take-up rates. And we know that everyone learns differently. Lots of people are on their phones. So we've got different things like postcards, emails, posters, we've got videos, and we have got written format material as well, but we're trying to make sure that whoever you're speaking to, whatever their learning style is, we've got something good for them that helps them really understand the benefits of salary exchange for them. Then there's a bit of process to be done. You have to decide on what way you want to implement salary exchange. This is a call out again for our people in the audience who already have salary exchange exercises in place. We see lots and lots of employers who start small and start on an opt-in basis, and I'm going to talk about that in a second. And I do wonder if people are sitting in opt-in arrangements potentially that should look at looking at opt-out arrangements or smart arrangements, or perhaps contractual arrangements going forward, to make sure that you're really maximising that employer saving, because those two have a higher take-up. And then lastly, we've got a couple of implementation pieces of collateral now, because we get asked for them all the time. So we've got an in-depth implementation timeline, and we've got a step-by-step checklist. So you can be assured that if you want to implement salary exchange through Scottish Widows, we're here to help you. So remember, just to close on this slide, successful implementation requires clear comms, proper documentation, you'll get support throughout the process, then regular reviewing and monitoring. And one thing that I didn't mention, and I should have mentioned right at the top of this slide, is you need to engage your payroll. When you've got so many things at play, apologies for those who know this already, but when you've got so many things at play, potentially qualifying earnings, weekly and monthly payrolls, variable earnings, when you've got lots of things at play, especially if you're choosing only to save some of the saving, you need to make sure that your payroll is equipped to deal with all of those moving parts. Really key. We have to do lots of rectifications where salary exchange has not been set up properly, and sometimes that can be because of lack of engagement with payroll up front. We'll just skip on to the next one. We can skip forward past this one if that's okay, because I've already mentioned it. That's just an example of some of our new collateral. Right, let's look at the estimator now. So quickly and easily, you can go online to our calculator and get an estimation of the type of savings that you can generate. So existing schemes, you can use it to see how much 15% is going to save you. New schemes, get on there and see what savings you can unlock today going forward from April. Quick and easy, and I think 4 inputs to get you your numbers. If we move on to the next slide though, this is where we get into the individual proof points, which will really help engage your employees about what you're trying to do with the salary exchange exercise. Now, proof points are also increasingly important because we really need to engage with our younger workforce as well. So like, we know, I don't know about you, but I've got an 18-year-old daughter. She just spends so much time on TikTok. TikTok is her research engine. So they want it on TikTok, they want it in 24 seconds, they want that dopamine hit. So we need to give them what they want. The perception for some of our young people, my nephew recently told me that he wasn't joining his workplace pension because it was expensive. So his £83 was turning into 312, free money for him, yet he still felt that was expensive. There's something wrong there, and we need to change the narrative. So they need to be able to visualise how much it's going to mean for them, not just at day one, but every single year, so that they can realise the cumulative effect on their savings. We need to give them something to relate to. So I was doing an interview yesterday, and I was talking about, you know, it's like an 8% for a basic rate taxpayer. This is like an 8% cashback and an 8% discount code. We need to reimagine it and communicate differently with our employees so that they get it, they understand it, and they fully appreciate it. Salary exchange means that they're not just getting pension contributions, they're reducing their taxable pay, reducing their NI contributions, and potentially, where they're keeping the employee saving, increasing their take-home pay. So The first angle is employees can see an increase in their take-home pay, and that might be hugely valuable for your demographic. But what about the increase in their pension and what that would actually mean for them? This is probably my favourite slide in the whole presentation. So if we can move on to the next one. So this is the cumulative effect of benefits being reinvested, right? So this is a 40-year-old. They're planning to retire at 65 roughly. They're on the UK average wage of £35,000. And purely through joining the salary exchange exercise, their monthly payment between employee savings and employer savings increases from £233 to £274. Now, no one's had to find any extra money. I know I'm driving this home, but it's just transformational for me. In any other industry, getting free money would be seen as a positive thing. Yet in the pensions industry, it's met with cynicism. So that extra money over a 25-year period, I've not assumed anything outlandish on the investment growth. I've only assumed 5%. That can result in an extra 20 grand in pension pot. That's magnificent, and that's something certainly, if you're looking to drive home the benefits of salary exchange and you're reinvesting the contributions, please contact us and we will help you do this for the average salary in your pension scheme. That is a brilliant story and really drives home the benefits for your employees. I know there's pressures on costs and a lot of schemes will do it that way, but if you do have this space to reinvest, I would say that that's fantastic. It's a fantastic option. Right, I'm going to move on to the next slide now in a bit of process. That was the exciting bit. This is the kind of process tick box bit that you have to consider. So there are three main ways to operate salary exchange, and I touched on that earlier on. So we've got the opt-in approach. So essentially, we know that salary exchange is an agreement between employer and employee. So on an opt-in approach, there is a proactive exchange of letters between employer and employee. And it does give the employee choice and flexibility, and it's really quick and simple for smaller companies. But it does generally result in lower participation rates, and there's a bit of admin. So if you as an employer are absolutely keen on maximising your employee saving, and you're a big company, opt-in's probably not going to be for you. Now, the specific documentation that you need, and we have wording guides in our employer guide, so you can just go straight there and get the wording. It must include permanent reduction in gross salary. We'll share these slides afterwards for anyone as well. Permanent reduction in gross salary, clear employer commitment to the pension contribution, the employee's right to opt out, because remember, with automatic enrolment, people can opt out of salary exchange and auto-enrolment at any point. So that kind of, it negates the lifestyle events that we used to have. Yes, it's good practice to still have them in there, but they should be overridden if an employee does want to opt out at any time. Then it should also include treatment of pay-related benefits and then actually life events. So just make sure that that wording is in there. So that's probably better for smaller companies who are growing and who have access to their staff, so they can physically do that exchange of emails or written. Sorry. So then we go into the opt-out approach, or you'll have heard of SMART or negative affirmation, and it automatically includes employees. And as Stuart said, we're 13 years into auto-enrolment, so employees are kind of used to the fact that they're auto-enrolled into a pension and they don't need to make any decisions. The downside to that is that they might be unaware, because we know that, you know, some employees think, right, I've been auto-enrolled, so my retirement is taken care of, and we know that that's not the case because there's a pension adequacy issue. So yes, it's good, but I would say definitely be in a position where you can provide those proof points for your employees. The HMRC's issue with opt-out, it's not an issue, but it's just a challenge, is they want to make sure that employees have been given an appropriate time to opt out before that first payroll deduction is made. So just be aware of that. 30 to 60 days is ample. It typically results in higher participation rates as well, which is fantastic. And as I say, it aligns well with auto-enrolment because it's simple, because there's no employee action. And then lastly, in the belt and braces approach, is contractual. So that's where it's included in the employment contract. It does require legal or HR guidance, so it'll be for the bigger companies out there. I'm assuming that's what most of our audience has. There may be some cynicism around change of contracts if you want to move from one basis to another, but it does result in the highest participation rates, and HMRC like it because there's an audit trail. So there are your three main ways, and we can give you help and support on all three. But contractual, you definitely would need HR and legal advice because it is contractual changes. Something that we get lots of questions about is around bonus, and I know it's bonus season at the moment for some people. There are two approaches to handling bonus exchange. Oh, by far the simplest one is the discretionary approach where it's not written into contracts. The HMRC don't need to see anything on this one. It's easier to implement due to timing. There's no contract changes, and it can be included in your normal bonus communications. So you're communicating that a bonus is going to be payable, the date that it's going to be paid, and then you can make that bonus election then. Where we do have some pain points is around the contractual approach to bonus. So there's very clear guidance on how this needs to be run, and I know that it definitely does give some pain points for some of our existing clients. So this requires written agreement to exchange the bonus before the bonus is earned. Sounds counterintuitive. I feel like it is. So, for example, a bonus could be earned for a financial year to 31st of December, but it might not be paid until April. That election to exchange the bonus needs to be done before the 31st of December, before the employee even knows what the bonus is going to be. So just be aware of that if you are setting up contractual bonus agreements, and be aware of the timing and the fact that HMR want to see the exchange before the bonus is earned rather than paid. And there is no right to revert once it's agreed as well. And it's going back to that, it's so it doesn't hit the pay packet so that the NI is sheltered. Hope that makes sense, but happy to take questions, obviously. What I wanted to do now is just look at some of the questions that come into us all the time and come into my team, come into the relationship managers who are on the call at the moment. Right, again, HMRC are clear on this. This must be a real reduction in gross salary. So in the documentation, it will be £35,000 salary is going down to 33.5, and that is a real reduction. Clear documentation and audit trail has to be there. However, positively for employees, and you as an employer can hold a reference salary. So that reference salary can be used for mortgage lending, it can be used for variable pay benefits, holiday, for example, holidays, overtime, etc. And I know that that is a concern from employees, but a reference salary can be retained. And I think most employers now hold a reference salary, which is obviously the pre-exchange salary. Right, another thing that we get asked about all the time are the minimum wage NI thresholds, right? So we cannot reduce salary below national living wage. So I think now, I was doing some figures yesterday for an interview that I was doing, and national living wage is looking like around £22,200 for a 35-hour week. So a sensible salary exchange floor, maybe £24,000. Now, this is for, and you may already know this, but I'm not going to make an apology for going through it again because we do get asked. An employee cannot reduce below national living wage for every single hour worked. So someone can't come to you and say they want to do 50, 100% of their earnings if they have a high earning spouse, because that will take them below the national living wage. So that's a key thing to know, that for every single hour worked, you can't contravene national living wage. And then lastly, maternity leave. We get asked this all the time. How does maternity leave interact with salary exchange? So a planning point here is, I would make sure that if you don't have a maximum exchange, make sure that you get one, so that you've got a maximum exchange of, say, I don't know, 40% or 50% of salary. Because on maternity leave, parental leave, adoption leave, it's your responsibility to continue on with that exchange amount for the period of paid maternity leave. So if you don't have a maximum, you could have employees opting for a really significant exchange while they're off, and then you would be liable to carry on that contribution. So it's just something to be aware of. If I move on to the next. slide. So this is something else that we have put in place. We've got a new employer implementation checklist, and this is just really around the things that we see from our employer clients. So the first point is make sure that your payroll is engaged and they've confirmed their capacity to handle whatever kind of salary exchange picture you want to put in place. I've spoken about this. Make sure that you've got clear salary exchange floors and maximum exchange amounts for the reasons that I've just talked about. Maintain an audit trail and comprehensive documentation records, especially for contractual bonus. Have clearly defined positions on maternity pay and other statutory benefits, specifically statutory sick pay. Yes, you've got a minimum responsibility, but it's up to you if you want to do something more generous than that, and also have clear policies for variable pay elements as well. If you do all of these things, that should really help. I would also think about preparing, detailed savings calculations for each review to make sure you're getting the most out of it, to make sure that is your method working? Have you got the right people in the scheme and the right people not in the scheme? Okay, so that's quite a lot. We've gone through quite a lot there, right? I think this is maybe my last slide, or it's nearly my last slide. So there's some really good ancillary benefits with salary exchange, right? So we've got the discount code, we've got the cash back, but there's some great other points that I think you should be driving home for your employees. So the first one is, especially now at the moment, immediate tax relief at source, right? That's fantastic. So with a relief at source scheme, you'll probably all be aware, your employees get basic rate tax relief at source, and then they've got to reclaim that higher rate relief. We know that hundreds of thousands of people do not reclaim that higher rate relief. It's part of life admin. It goes in a too difficult box and it doesn't get done. That's leaving free money on the table from the HMRC. The brilliant thing with salary exchange is that your employees get the correct relief at source. Now, that's particularly important because we've got frozen personal tax thresholds, as you'll know. We've got them right up till 2026. And I think the last headline that I saw, correct me if this is not exactly right, but I think media were saying that an extra 1.4 million people are going to cross into higher rate tax for the first time because these thresholds are being frozen. So really good to communicate with your staff that are in that type of bracket that they're going to get the correct tax relief at source because you're operating a salary exchange scheme. Preserve child benefits. So again, high income child benefit tax charge, again a bit of a tongue twister. So for your employees who earn between £60,000 and £80,000, being in salary exchange reduces their gross salary and might preserve some of their child benefit. So again, a planning point for them. So that's another one. Student loan repayments for your young people. Again, gross salary reduction means that student loan repayments might be reduced or deferred, which might just help cash flow for some of your younger employees. And then at the other end of the spectrum, you've got your high earners and your personal allowance protection. So for those high earners at £100,000, you will know again that you start to lose your personal allowance. Doing salary exchange may take them under that magic 100k mark. And again, access to free childcare is another £100,000 point. So there are some really good points that you can communicate with your employees on their individual tax planning, proving that salary exchange really is, I really do believe it is win-win for the right employee. If I move on now to just the resources available, I've kind of tipped the nod to these across the whole presentation, but there is an employer site where we have put everything that we can really comprehensively to help you with an end-to-end implementation exercise and also review process. So we've got the calculator, which is individual and group, and we've got lots of different collateral. So please do go and check it out. My team, the marketing team, we have poured our heart and soul into this based on advisor and employer feedback. So I really hope that you find it useful. That is enough from me. I'm conscious, Stuart, that I've ran on as we anticipated that I might do, but I hope that that's been useful for everyone.
It's okay, Susan. We kind of take account of that now. I've talked about your enthusiasm at the start. We can't hold you back. I hope people are getting that this is a good initiative to potentially implement if you've not. and look at those key moments and how you operate if you already do. So Susan, thank you, lots of super help there. And you know what, great to see the support available online. Advisors, of course, can offer a huge amount of support in this space too, and our relationship managers can support as well. And I'd like to highlight some of that we can offer via governance. Now, we produce regular reports, and our relationship managers can support you by highlighting some next best actions from the management information that's in the governance reports and various other ancillary documents. Overall, they're also looking to try and assess the success of engagement plans. And one aspect of the governance data allowed us to revisit an over a decade old auto-enrolment problem with an employer who had implemented their scheme with us. So on the next slide, you'll see a view where it showed a significant amount of people making payments themselves as an employee. Now, we know a salary exchange payment is made by the employer. So this showed that people were not paying via salary exchange. Now, it could be legitimate. As Susan has already covered, salary exchange is not right for some people, particularly on a lower income, as they should not be taken below the national minimum wage. However, in this example, it wasn't the case. In this example, despite operating the scheme on salary exchange and enrolling new members on that basis, this governance data was highlighting nearly 800 people paying £83,000 a month themselves as an employee. When we investigated this cohort, they were people that were originally auto-enrolled into the pension when this company staged for auto-enrollment in 2013. This employer, up to that point, people were opting into the pension and therefore opting into salary exchange. So at the point of auto-enrollment, actually at the very start of auto-enrollment, you couldn't operate an opt-in salary exchange whilst you were auto-enrolling employees. So these people, from a salary exchange perspective, were left behind. Now, we work with this employer to communicate with this cohort on an opt-out basis to auto-enroll these people into salary exchange. It saved £12,500 per month, or £150,000 a year in employer national insurance. £150,000 a year in employer national insurance. So I wanted to highlight this example of, really, it's our active governance suggesting next best actions, really supporting you as our employer client. And we can obviously support with material and webinars to help your people make the most of the opportunity for them. If you do want to know more, please do get in touch after the session. So look, let me summarize the key benefits of salary exchange for both parties. Between what both myself and Susan have talked about, we've looked at, for employers, there's a reduction in annual costs through those national insurance savings. You can certainly help improve retirement outcomes for your scheme members should you look to enhance the pension contributions with the national insurance savings. There's an opportunity, of course, to reinvest savings into enhanced benefits, be that a death in service scheme, be that some other well-being benefits or health-related benefits. Obviously, for employees, boosting the pension savings, that's what we're about at Scottish Widows. We passionately believe in people making the most of their retirement savings. So boosting the pension savings is what we are looking for people to do. Obviously, there's a potential in increasing people's take-home pay. And of course, what we're saying here, there's some absolutely massive tax planning advantages. So look, that is covering all of our content for today. Before we look at your questions that you've been asking, I'd just like to gauge what you will do as a result of what you've heard so far. So our final poll asks you, what actions will you take as a result of this webinar? And the options to answer simply are, you're considering introducing salary exchange, you'll review your current salary exchange take-up, and/or you might be looking to re-communicate the benefits to your people, or something else. There's no space to put what that something else is, but there's certainly a feedback form at the end for you to tell us what that something else might be. And look, Susan and I, we truly believe there are opportunities, great opportunities for anyone with salary exchange. I'm hoping you've taken away a number of thoughts from today to make a real difference to your people and the retirement outcomes for all of your people. And certainly, if I look at the poll results Now, that third of you that was, let's just move on my screen, that third of you that didn't offer salary exchange, it seems to be that same third you're now considering introducing it. So that's absolutely fantastic. And certainly 50% of you, over 50% of you, are looking to do something in terms of reviewing the arrangement or recommunicating the benefits. So please do get in touch. We'd be delighted to help. There's 9 of you that's thinking about doing something else. That's absolutely fantastic too. I'd be really keen to understand what that something else is if you pop it in your feedback as the webinar closes. So, Susan, I think it means that it's question time. There's certainly a number of questions that we've had. Thank you, massive thank you to Chris Myerscough and Damien Berwitz for answering the questions in the background, and certainly they've given me a couple of tips of what we should be asking you right now. There were a number of questions. I'm going to start with something I'm not going to ask you, Susan. There were a number of questions around the minimum level of salary to retain and how salary exchange interacts with the national minimum wage. You then covered that in quite a lot of detail. It's a floor you can't go below. So I don't think I'll ask you that again. But certainly, you also covered maternity leave. But last week, you were doing a lot of work for International Women's Day, sharing research from our Women and Retirement report. So can you expand on what does good practice with maternity look like? And we've had a question specifically from Sandra on what happens during extended leave where there is no pay. So if you can maybe cover that for us again, please.
Yeah. Obviously, Stuart, you know my 2 passions are salary exchange and the glow up that it needs to be moved away from salary sacrifice, but also closing that gender pension gap. It is absolutely key for me. You know, we need equality and we need women to not be worrying, not be financially vulnerable in retirement. So I'm a huge advocate for that. So in terms of maternity pay, and thanks, Sandra, for the question. So what does good look like? Right, I'm aware of cost constraints, right? So we know that employers have to maintain the level of arrangement at the pre-maternity, and that has got to be for the period of paid maternity leave. When we get into unpaid maternity leave, that's really down to you as an employer. I would say, and I would love, but I'm not an employer, I would absolutely love to see that continued on. For the period of full maternity leave, but I understand that that could be costly, even if it could be extended out partially. I also am a huge advocate for when people do return, potentially on a part-time basis, that for a specific period, their pension contributions are continued. So that really is down to you as an employer, but I do believe that it would be brilliant to see some employers adopting to continue contributions, even if it's at a reduced level for that unpaid period of maternity leave. But that's down to how you want to set salary exchange up. Not many do it in my experience, and I would love to see more people do it.
As you say, Susan, it's the exception rather than the rule. We do have a handful of clients that do offer that extended period. There's one I can think of that also, it's very typical, of course, when you come back from maternity leave, little one is little, so you perhaps don't want to work full time. One particular company I know of, they actually sort of galvanise that period of part-time working and pay pension contributions based on full-time earnings for 1 year after maternity leave. So some wonderful examples. The rules are minimums, folks, so you can go further. Obviously, we know you're balancing out your own employer budgets. Susan, obviously, we've seen income tax thresholds not changing. Mm-hmm. I wonder if there's anything to consider there.
Yeah, so I briefly covered this just now, but this is a big deal, certainly for me. I don't know about anyone here, but and I'm ashamed to admit this, but I do have a big bag of pension paperwork, a big bag of life admin. The life admin pile is meant to be done on a Saturday morning. Is it done? No, it's not. So we know that basic rate taxpayers are pretty much taken care of with relief at source arrangements. We also know that lots of people do not claim their higher rate tax relief, which I mentioned earlier. We've got more and more people crossing into that higher rate tax bracket. And with salary exchange, you as an employer can basically say to your employees, hey, we've got you. you're getting the right amount in your pay packet because we've implemented salary exchange. And certainly as an employer, I would be talking to my employees who are in that bracket, crossing that 50 grand, depending on where you are in the country, and just letting them know that they can be assured, because they're an employee of yours, that you're making sure that they're getting the right amount in their take-home pay.
Brilliant, brilliant. And I see there's a question from Alex around, just wanted to absolutely clarify the minimum contributions for auto-enrolment. Can salary exchange be used for those? Absolutely, Alex, they can. We've been talking about the minimum wage, the national minimum wage, and taking people's pay below that threshold. That's where it shouldn't be used. So you might have to, for certain people, limit the effect of salary exchange just to make sure that that floor is there. Most payroll systems do have that floor and do catch that scenario. And as I mentioned, payroll, Susan, we might have people who...
Yeah, sorry, can I just mention something really quickly before we talk about that, because it's something that might be interesting for people who are on the call who haven't implemented, who are on qualifying earnings. So we know that the direction of travel from the government is that the lower earnings limit on qualifying earnings will be removed at some point, right? It's the long term, but it will happen. And what we've been able to model is that if employers implement salary exchange, it can almost cost neutralise that removal of the qualifying earnings, lower earnings limit. So when qualifying earnings goes, it means that employers are going to have to find that contribution level between 0 and 69.6. If they use salary exchange, it can negate that cost increase. So it's a really good story to say we're going to redesign the scheme, give you more benefits, but it may cost you a minimal amount if your staff salaries are around the national average. Sorry to interrupt you. I just thought that was really important to get out.
No, not at all, not at all. I think I've got time for 2 more questions, Susan. So I'm going to ask you a payroll-related one, and then I'm going to go back to sick pay and paternity leave, not just look at maternity leave. So we've got a lot of pension managers, I think, on the call, people who mainly deal with pensions rather than specifically payroll. So what should a pension manager who doesn't deal with payroll, what should they do? What are the most important things that they should do?
So if we go back to that implementation piece, and this is why the implementation process document will be really helpful for those people, is you want to make a decision as a company on what basis do you want to implement salary exchange. So right back at the basics, what are you going to do with the employer saving? Are you going to save it, or are you going to redirect it, or are you going to do a proportion? What are you going to do with the employee saving? Are they getting it in take-home pay, or is it going to pension contribution? Also as well, if you're on qualifying earnings, if you've got variable pay, when you've got all that in a document and you're very clear on what you want your vision to look like for your salary exchange exercise, you've got to engage with your payroll and make sure that they can cater for absolutely everything that you want to do as an exercise. And if they can't, please don't try a manual workaround, because it will just give everyone a headache, but primarily you.
And probably from, unfortunately, bitter experience, the most important thing in terms of pension contributions coming across to your pension provider, where it's salary exchange, those contributions should be coming across as employer payments. Please don't send those across as employee. We've seen it far too many times, Susan, haven't we?
I know, I'm laughing and it's really not funny, but the amount of times I'll be speaking to a client and they'll say, yes, we're on salary exchange, yes. And then I'll look at the data and we've got employee and employer contributions across the board. So yeah, avoid a costly rework. Sounds basic, but it's something we see all the time.
And it is costly because it inflates people's pension. They're getting what should have been passed us across as an employer payment because they've already saved the tax and national insurance. It's going in as an employee, and we are applying basic rate tax relief. So it's inflating their retirement policy value. And that, unfortunately, creates a problem for the individual as well. So a really important point, folks.
Like, don't get me wrong, right? The benefits are brilliant. The benefits are fantastic, but there are definitely pitfalls. And that's why this is my genuine opinion. It's not Scottish Widows' opinion. If you're going to do this, you want to work with a partner who, this is the day job. They know the scenarios. They've seen it. They've got the support to offer you the communications, and they're there on hand to help you with things like this. That's why I'm really confident in talking about this today, because I know that we can be that partner.
Absolutely. Susan, 4 minutes left. I think that's maybe
Okay.
one question more, but you never know. If you answer it quickly, we can squeeze another one in.
Okay.
I see Deborah has asked, if an employee has sickness deducted, should the employer still contribute what has been agreed on the salary exchange document? So cover for us, I know you cover maternity leave, but cover for us paternity leave, parental leave, any other leave, and also sick leave. And
right, so they're two very specific things with very different rules. So you've got maternity, paternity, adoption. They should all be treated the same. Makes sense, straightforward. So maternity, paternity, adoption, I would suggest that, you know, for periods of paid leave, that the employer maintains the contribution. There's no such rule for sick pay unless it's the way that you've set your salary exchange agreement up. So obviously we know that in statutory sick pay, nothing can be deducted from the employee for pension contribution, but the employer, so that would be under a lifestyle event, for example. So the employer can then just pay on the actual earnings, depending on how they've set the salary exchange agreement up. If they've set the salary exchange agreement up, that when someone's off sick, the contributions are maintained, then of course they would have to be maintained. But there's no similar arrangement for maternity and sick pay. They're very, very different. And I would suggest that the norm is that salary exchange is broken while someone's off on statutory sick pay and actual earnings are used and nothing's deducted from the employee.
Yeah, because we're talking about being fair here, aren't we? And obviously from a maternity and paternity leave perspective, it is ever so slightly different to sickness. But of course, employers, you can offer whatever you want as long as you adhere to the minimum levels. Is there a practice that some employers have, Susan, around maximum exchanges or time limits on when people can make changes?
You'll remember, for those of you who do have salary exchange arrangements in place, you'll remember that good practice was changes could be made once a year. Now, you can still have that good practice so that you're not bombarding your HR or your payroll with changes. So good practice review period could still be 12 months. But if an employee comes to you and wants to opt out, then they have to be given that option. But yes, I would say 12 months review period is still sensible.
Sensible. Susan, I'm so tempted. I can see there's one question that Chris and one question that Damien is answering, but no, we'll let them answer the questions. That's my little cue to them to say, hurry up, fellas, because as soon as we close, unfortunately, the webinar closes. But if we don't, oh look, Chris has just answered his, and Damien, your answer to Douglas hopefully will be quick. If we don't answer your question, Douglas, we will send it you separately after this webinar, because that really is all we have time for, folks. We very much hope you've taken a lot from today, and with it, we hope you'll make a real difference within your businesses and with the many families that your pension scheme support. As I mentioned at the start, this session has been recorded. You will receive an email over the next few days with a playback link to the recording. It will also go onto the Scottish Widows webinar, webpage for employers to use, and you can look at all of our other webinars in this expert series as well. And I know one or two of you have asked about our employee webinars. Our Retire Well webinars are available as playback as well. So certainly I saw a question about a lost pensions session. We did that one in November, and we'll do it again later on this year in line with National Pension Tracing Day. We're absolutely keen to gauge what you think of today. There'll be a feedback form launch as soon as this webinar closes. Your feedback helps us to ensure the content is relevant to you, and obviously it helps us plan for future webinars. So please do take time to complete that and tell us what you think. It just leaves me to say many thanks to Chris and Damien for their hard work in the background with your questions. And of course, huge thanks, Susan, our salary exchange expert, bringing to life the benefits and the best practice. But most of all, thank you to all of you for taking the time to join us. Enjoy the rest of your day, and goodbye for now.